Thank you so much for joining us today. Largely anticipated given the fact that inflation is down at 14.3% in July. So has there been any market reaction from the shilling through to yields on government debt?
Indeed, this move was largely anticipated. I think all of the 6 Bloomberg analysts that were inquired over the past weeks did foresee a rate cut, although at that point in time they had indicated a 100 basis point cut. But I think the 200 basis point is not out of line with our expectations, indeed because inflation had come off by close to 400 basis points in July. There hasn't been a very sharp market reaction as of yet. We saw that the Ugandan shilling remained fairly stable against the United States dollar today, just closing slightly weaker at levels of 4,000 close to 95 from an opening of 90 earlier this morning. We don't expect the shilling to come under severe pressure as a result of this move. We do expect the shilling to remain fairly range bound over the foreseeable future, likely to stay below those levels of just by 500. So we do expect the shilling to remain between 4,650, 4,000 and 4,500 in the foreseeable future. On the T-bill side, as well as the government bond side, we are expecting that yields will come off quite considerably. We have a T-bill auction next week. The last 91-day printed at 18.1%, and we are expecting that the curve will disinvert over the next 3 months, with T-bill yields falling to approximately 15% over the next 2 months.
I mean, what impact will that have on foreign investor appetite for local debt? Because and how important is it for government to keep this premium going when it comes to those yields?
We have indeed seen that the yields have been very attractive to foreign investors over recent months. We had quite considerable portfolio inflows from Q3 in 2011, but more recently we've seen that the appetite for Ugandan debt has dissipated somewhat, and we don't foresee that foreign interest will remain very strong even at present levels. We do still feel fairly neutral on the currency despite yields coming off quite sharply, so we feel that, as I mentioned, over the next few months the Ugandan shilling will remain stable, but foreign interest has also decreased somewhat as a result of the higher withholding tax introduced under the current fiscal budget. We do foresee, however, that the currency could come under pressure over a more medium-term look, so a view. So when yields have declined quite sharply, and we see domestic demand coming back on stream quite vividly. So we don't expect very significant interest from foreign investors into the bond market and or the T-bill market for the foreseeable future. This has been very supportive of the Ugandan shilling, but we feel that the slower domestic demand at present will see that import growth will remain fairly subdued, and that will be supportive of the Ugandan shilling.
Now, the general view is that disinflation will continue. You've got core inflation expected to reach around 7% at the end of 2012. That's according to the central bank, and then 5% in 2013. What does this mean for the interest rate cutting cycle, which of course is clearly underway right now?
Absolutely. So under the monthly meetings of the Bank of Uganda, there is significant room to cut at subsequent meetings. So we do expect this cycle of monetary easing to continue. We expect headline inflation to be in single digits by September. At that point in time, the base effects on the headline inflation will be quite significant. In September 2011, we had month-on-month inflation of 6.8%. So that figure in terms of headline inflation will come off quite considerably in September. So both at the August meeting as well as in the September meeting, there will be room for further significant cuts by the Bank of Uganda.
Yvette, thank you so much as always for joining us and unpacking that decision. Yvette Babb of Standard Bank.